What if the economic collapse everyone fears has already begun, not in some distant developing region, but in the heart of the Western world? Because right now, both the United Kingdom and the European Union are facing a financial reckoning, not just recessions, not just stagnant growth, but fundamental cracks in the systems they rely on to survive. Some claim Brexit sabotaged Britain's future. Others argue the Eurozone is a time bomb waiting to detonate the moment one key country falls. We are told that the UK is collapsing. We are told that the EU is collapsing. But both can't be right, or can they? So in today's video, we're not asking if there is an economic crisis. We're asking, who is actually closer to collapse, the UK or the EU? And the answer might not be what you expect. Because as we peel back the layers of history, policy, and data, a disturbing pattern emerges. They are racing toward the same cliff from opposite directions. So stay with me. What you're about to see will reveal more than headlines ever could. To understand this crisis, we need to step back. The European Union, as a concept, was built on optimism, unity, integration, a shared destiny. A belief that economic cooperation would prevent the wars of the past. The goal was simple: make Europe strong by making it one. Meanwhile, the United Kingdom stood in the doorway, 1 foot in, 1 foot out, participating selectively, avoiding the euro, demanding exemptions, present, but never committed. This was not merely a political stance, it was a financial identity. The UK believed in the strength of flexibility, currency independence, market deregulation, and a global outlook. The EU believed in the strength of structure, rules, alignment, and shared governance, to systems, to philosophies, to futures. But what neither side anticipated is that their weaknesses would mature faster than their strengths. Because during the decades of calm, both systems accumulated silent debt, silent stagnation, and silent structural risks. They created the perfect contradiction. The EU cannot stabilize without unity. The UK cannot grow without the world, and neither of those conditions can be guaranteed anymore. Let's break down the foundations. The UK model: global financial services hub, rapid capital movement, dependence on imports and foreign labor, currency flexibility as a shock absorber, deregulation to fuel investment. This made London a magnet for global wealth. But it also meant that when shocks hit, the UK feels them immediately and violently, like a speedboat, fast, agile, easy to capsize. The EU model: integrated markets, shared standards and protections, central monetary control via the European Central Bank, structural funds to support weaker members, the euro as a symbolic and practical anchor. This created a system that could withstand local crises but struggle with asymmetric shocks, like a cargo ship, stable, slow, and impossible to turn quickly. And then the perfect storm: 2008 global financial crisis, 2010 European debt crisis, Brexit referendum, pandemic shock, energy crisis tied to geopolitical conflict, global inflation cycle. It didn't matter which system was better, both were suddenly operating outside their design limits. Because when the shockwaves hit, a truth emerged. The UK's model collapses when global capital retreats. The EU's model collapses when member states diverge, and both are happening at the same time. After 2008, the cracks began to show. The UK's breaking points: bank bailouts revealed the fragility of financial dominance. Currency swings exposed import dependency. Long-term wage stagnation signaled productivity decay. Brexit introduced friction where friction is lethal. Borders, paperwork, uncertainty, political instability undermined investor trust. The country's economic engine, London finance, now had to compete without automatic European access. A core advantage was suddenly not guaranteed. Meanwhile, internal regional inequality grew. The prosperity of the South did not reflect the reality of the North. A nation that looked unified on a map looked divided in the numbers. The EU's breaking points: Greece, Spain, Portugal, and Italy struggled under debt burdens. The euro prevented currency devaluation as a recovery tool. Germany's industrial model faced global competition and energy vulnerability. France confronted structural reforms nobody wanted to touch. Demographic decline pressured pension and healthcare systems. The Union could save the Eurozone, but only at the cost of binding countries into rules they did not choose. And the moment Italy or another major economy falters, the EU cannot realistically bail them out without triggering political rebellion from the north. The euro became a paradox, too big to fail, too rigid to save everyone. So who broke first? This is where the mystery deepens. Because both systems were breaking, just in different directions. The UK was breaking from exposure. The EU was breaking from restraint. Like two bridges collapsing from opposite sides of the river. Which brings us to the present. Let's analyze critical categories to see who is closer to collapse, based on structure, not predictions. Category 1: Debt sustainability. UK. High national debt plus sensitive bond markets plus currency pressure. EU. Some states carry unsustainable debt levels. Shared currency removes individual flexibility. Advantage: neither. Risk dynamic. UK gives currency confidence, risk. EU gives systemic domino risk. Category 2: Energy and industrial base. UK. Import dependency plus infrastructure transition costs. EU. Industrial reliance on external energy plus vulnerability to supply shocks. Advantage: slight. EU, due to scale and negotiation power. Category 3: Trade position. UK. Trade friction, smaller domestic market, service-based. EU. Large internal market plus export diversification, but over-reliant on external partners. Advantage: EU structurally. Category for currency stability. UK pound can adjust, but volatility carries costs. EU euro is stable but locked. Crisis in one region threatens all. Advantage depends on scenario. Short-term UK, long-term EU. Category 5: Demographics. UK. Manageable aging curve. Immigration inflows fluctuate. EU. Aging population in multiple states. Low birth rates. Pension pressure. Advantage: UK. Category 6: Political cohesion. UK. Internal identity crisis, regional pressure from Scotland, Northern Ireland issues. EU. Fragmentation risk between nations, rise of anti-integration parties. Advantage: neither. Political fragility on both sides. Category 7: Economic resilience. UK. Flexible but exposed. EU. Stable but constrained. Advantage: scenario dependent. There is no single winner or loser. Instead, there is a disturbing conclusion: the UK is closer to rapid collapse, the EU is closer to systemic collapse. The UK could fall suddenly, triggered by investor flight or political miscalculation. The EU could fall gradually, eroded by divergence until the Union becomes unsustainable. The crisis is not about who collapses first, it's about how they collapse. Attempts to fix the systems often made them worse. Monetary stimulus to ease short-term pain created long-term inflation pressure. Structural reforms were either too political to pass or too weak to matter. Narratives replaced strategy. Global Britain versus European project. Both sides doubled down on identity instead of economics. The UK believed independence would unlock growth, but underestimated the cost of distance. The EU believed strength was found in unity, but underestimated the cost of enforced alignment. As a result, both are now trapped in feedback loops. UK gives decline leads to investor fear, gives fear leads to currency. Pressure gives pressure leads to higher import costs, gives costs fuel more decline. EU gives divergence leads to political fragmentation. Gives fragmentation, stops reforms, gives lack of reforms, weakens the Union, gives weakness, fuels more divergence. History doesn't repeat, but economic systems do. No matter what year you look at, certain trends appear again and again. Productivity gaps between regions widening, debt servicing becoming a major budget component, dependency on external suppliers for critical materials. Real wages struggling to match living costs, governments relying on temporary measures to pretend permanence. Each trend on its own is survivable. Together they form a crisis. When systems fail, they don't collapse from one weakness. They collapse when multiple weaknesses activate at the same time. That is what makes today different. The UK and EU are no longer facing economic problems. They are facing system design problems. This is why predictions are so difficult. Traditional metrics weren't built for this. It's not about interest rates or GDP growth projections. It's about structural viability. Conclusion 3 takeaways. Takeaway number 1. The UK's greatest strength, flexibility, is now its greatest vulnerability. Takeaway number 2. The EU's greatest strength, unity, is now its greatest liability. Takeaway number 3. Collapse, if it comes, may not look like failure. It may look like transformation, because economic systems don't disappear. They evolve or they break trying. This isn't a story of winners and losers. It's the story of two models that were designed for yesterday's world, and are now racing to adapt to tomorrow's. If nothing changes, the question isn't who collapses first, but rather who survives the collapse better. And that is the question policymakers should be asking right now. If you found this breakdown valuable, and you want more deep dives into global finance, collapse scenarios, and economic history, make sure you hit like, subscribe, and drop a comment telling me, which economy should we analyze next? And remember, economics isn't just numbers, it's the story of civilization. See you in the next video.